Welcome to Barchart's Market and Close. I'm your host, John Rowland, Barchart Senior Market Strategist. And on today's show, what is the difference between a dip and a price shock? And what can we learn from past to help us with today's markets? The dollar's relationship with commodities typically is inverse in nature, and recent dollar activity has liberated commodity prices, including gold. Recent big winners. We're going to look at Meta and Palantir. And all that plus your questions, and to help me out with today's show is my co-host, Mr. X, Thomas. Hello, Thomas.
Good morning. Well, good morning to me, John. Good afternoon to you. How you doing?
I'm doing well. On yourself?
Doing good. Doing good. Just hanging out with the roosters over here, John. 3:30 in the morning, as per usual. So I got my coffee. I got my extra strong coffee here, John. Ready to rock and roll today.
Would that be Bangkok Roosters?
Hey, you got it. You got it, John. All right, folks. So we got a lot to cover today, which you probably saw in our teasers for the week. But John, I just want to give everybody a quick reminder. If you're watching on our website and you want to ask a question, just click the tab at the top right. You'll see it highlighted in orange. If you're watching on YouTube, go ahead and ask those questions directly in the chat, and we will get to as many as possible. All right, John. So Monday was kind of a scary day, John. We saw the biggest drop we've seen in quite some time. A lot of people were wondering what was going on. Some people thought it was related to DeepSeek, a threat to U.S. big tech. Others were saying, no, this is about the Japanese yen carry trade. Who knows? Could be a multiple of reasons. But, John, there's one person undeterred by what occurred, and that is our friend from Fundstrat, Mr. Tom Lee. Permabull Tom Lee, but that's okay. We like permabulls around here. John, he calls Monday's price plunge the biggest overreaction since the onset of COVID, which is about 5 years ago. So, John, the question for you is he right? Was it an overreaction? And is it perhaps time to buy the dip, or should we be concerned?
Yeah, I mean, I think I take a little not offense, but trying to compare an intraday movement of this nature to like the COVID, right, where it was multiple days and months. I think that's a kind of an over exaggeration, but I think there is some kind of truth into this idea of between buying a dip and what we call a price shock. And so, for some of you might not know, or well, first of all, let me talk about price shock. Is that price shocks usually tend to be short-lived. In other words, you get this quick movement in one direction and the market recovers very quickly. But when you have a price shock that creates a gap, in other words, and price falls without having any trading, then get those types of gaps, or those price shock gaps, are what we would typically say is there is a change in the fundamentals of a market, either real or perceived. And I think that's kind of what your point is. So first of all, I just want to show folks here under the investing page, under our Barchart screeners, you can find a screener which is called the end of the road. And this screener, what this does is it looks for stocks that have been in expansive or exponential rallies that gap lower, which kind of breaks a trend line, and this could be the sign of a beginning of a new trend, a new sideways or a downtrend. Not necessarily always has to happen, but what it's identifying is this gap and this imbalance between buyers and sellers. And this gap is created as the market is seeking out new buyers. And we're going to talk about that a little bit at the end of the segment. So if you're interested, there is a webinar in our archives. Just go in there and search under the word road, and you'll get to that webinar. But so what was interesting about that particular day is, now I've been collecting this watch list here of end of the road candidates. What happened on that particular day, this screener usually picks up maybe 2 or 3, maybe 5. I think today it's about 6 on any given day. But on that day, we had 70 candidates, and all the candidates were literally the who's who of everything about this ripple that we've talked about in the AI segment. So let's do this. I want to go back and look at some former end of the road gaps and show you that's kind of this probability of what price is going to do, and that you can make your own assessment on, is this a buying opportunity? Because a lot of these stocks did have this end of the road type gap. So here's Google from, let me just get rid of the comparative here. This is Google from the summer. And here's the end of the road gap. And usually what you'll see is that you'll see a large percentage drop. Now, usually a drop below the 50-day moving average. And this is kind of the 50-day moving average is going to be kind of our demarcation line through all this analysis. A gap below it usually signifies that the market needs to go back and test the 200-day moving average, as you can see here. But it's important to also identify these gaps and where the 200-day moving average is at that time, because when the market comes back to that levels, you know how I feel about gap fills, this will act on the market. In other words, it will act as a level of resistance. And you can see it happened twice. And it was not until we gapped above there that Google recapture or continued to move higher. Now here's Lilly. Lilly, the same thing. Here we can see we had an end of the road gap that fell to the 50-day moving average. Typically in that scenario, what we'll see is that the market will hold or defend the 52-day, and it might get that quick recovery back into that gap, or it'll pause, right, and then continue on towards the 200. Now, this one didn't objectively achieve the 200-day moving average, but again, I use this one as a great example, is that, you know, when we came back to where the origin of the gap is, how it acts as a level of resistance, and this was a major level of resistance, and since then, Lilly has gone lower. So here's Microsoft. We'll talk about what's happening in Microsoft in a second. But here was a previous sell-off. And again, a gap below the 50-day moving average tends to send the market towards the probability of the 200-day moving average. And again, notice how since then, you know, we've kind of floundered around this level, not getting back or above, you know, these least recent highs. So here's kind of cues, and the cues here is what we want to see, right? So here's a gap that fell below the 50, retested the 200, and then what we want to see is that nice V bottom recovery, right? And then fill the gaps, react, fill the gaps, react, and then eventually take them out. So that's what we want to look for. What we fear is when we see something like this, where we see a market that not only falls below the 52-day moving average, the 50-day moving average, but falls right to the 200-day moving average. I don't feel like there's a lot of rush to get back in the market. This might not be a great buying opportunity. We might need to wait for greater conditions, because look, I'm going to show you in the next 4 charts real quickly. These all fell to the 200-day and have yet to recover. So let's look at NVIDIA. And I think this is really kind of sums this all up for us, because most of us are thinking about there was a fundamental change in the, for instance, in the semiconductor space because of this idea of DeepSeek. By the way, also today I saw a news story about Alibaba has an AI that could be disruptive as well. But not only did, now, again, in this case, the NVIDIA might be a little bit different. We don't see that stacking or the real strong upward trend, but we have been in an upward trend in NVIDIA. But we have gap below the 50-day moving average, and we've fallen right to the support of the 200-day. And so at this point now, Thomas, you know, we see we did try to get that recovery, that price shock recovery here on this green candle. But the way we kind of look at this now is, you know, this is a range that's going to help us define risk.
Yeah, and it actually looks, John, with NVIDIA, it looks like it's headed potentially, unless things change in the next few minutes, for its first weekly close below the 200-day moving average in 2 years, John. 2 years. That's a big deal, in my opinion.
Right. So again, look, you can see here we came untested, and then the next day we got that big green candle. Again, that's kind of this price shock idea. Well, what does that kind of tell us? Is that that's the condition that we've been kind of Tom lead, right? Buy the
Yep.
dip. This is a buying opportunity, right?
Exactly. So we opened up with Tom Lee says this is a buy the dip opportunity. Retail agrees with Mr. Tom Lee, John. So on Monday, investors bought the dip in the Qs to the tune of 4.3 billion, the largest inflow since 2021, John. So they're taking Tom's advice. I've been a buy the dip proponent for a long time as well, John. I've said so on the show multiple times that buying the dip has worked over the past couple of years. Do you think investors are just kind of jumping the gun just a little bit here?
Well, that's what I'm saying. I think the conditions here, if we had fallen to, say, to the 50-day or fallen in between the 20 and the 50-day, then I would say, hey, yeah, maybe this was probably a buying dip opportunity. But what I'm saying, the conditions here are more in line with those higher probabilities of greater uncertainty. And I know that's a lot of wishy-washiness, but what we can do here is say, let's look at this as a trade. And we know that if we are buying this as a dip, that our risk now is this most recent low. And really, if I'm looking for a buying opportunity, again, thinking about if price recovers or when price recovers, we need to get above this green candle, but we have to also be respectful that the gap itself resembles or represents a layer of resistance. Now, in this case, not only is it a layer of resistance because it's a gap, but now you have the 50 and the 200 day between you. So again, I think, yes, this could be a buying opportunity for a company that has a strategic advantage in a very unique space. But the probabilities are telling us that this is telling us to be more cautious and wait and see. And what we don't want to see is, something like this, where we get a little bit of a bounce and we don't recapture the 50-day moving average. Or here we can see, we come to the 50-day moving average and then, we're now back below the 200-day. Here's Whirlpool. Was even a worse, right? So it's all the way down to the 200-day, and it certainly doesn't look like it's going to recover. So keep that in mind over the next few days. And what I'm saying is, there's no rush to buy this dip in a lot of these markets.
All right, good advice there, John. All right, so we've got a lot more equities coverage later on in the show, John. But let's kind of switch gears and go to precious metals. So gold, something we haven't talked about in a little while, John, just because it felt like it had fallen out of favor ever so slightly. That has completely changed this week. Gold made its third new all-time high today, but this third of the week. So gold is on fire, John. It feels like it's getting back in the public eye. People are talking about it just a little bit more. What do you think? What do you think is going on with gold? And are you getting excited about what we're seeing?
I kind of am a little bit. I'm always cautious. I always look at the market from the side of risk. But I think what we can talk about here first is why maybe gold is moving. And I really do believe it starts with the dollar index. And in this correlation between the dollar and all commodities. And that if we go to, let's say, a chart of the dollar index, let's say over the last month or so, you can see that, we have had a weakening dollar. Now, prior to that, the dollar has been super, super strong for a lot of reasons. First of all, the fact that the U.S. economy is probably the strongest economy in the world. The second is that, our long-term rates are a lot more competitive, or it's influx of capital. So all of those things have been positive, but some of those things have changed. Like you said, the Japanese Bank of Japan raised their rate. That changes the carry relationship to some currencies. But there's also this fear about tariffs that could happen as well. So the dollar has fallen. So what we can see is that if we look at this relationship between dollar and commodities, dollar has fallen over the last month. And if I look at what is happening in the commodity space, now this is the futures markets, but we can get that sense. We can say, wow, a lot of green on the board and not a lot of red on the board. And so this is kind of what we're talking about, is the market is kind of this headwind that has been pushing against commodities is now lessened and is now actually becoming more of a tailwind. You can see that gold is up almost 6% in just a month time. So let's go to the GLD. Let's do that, which is the ETF. And those of you who are not familiar with it, this is the gold ETF. It represents about 1/10 of an ounce, but it always trades at a little bit of a discount. I just want to kind of show you the cash price for gold today. It was around 2,800. And if we look at the GLD, it's trading around 260. So it's trading to about a $20 or $200 discount. So just keep that in mind when we do our chart analysis. So what I'm going to look for here is, recently I did a little Fibonacci extension, and, I have to respect Fibonacci extensions, but they also can be targets. So we are getting above this most recent high, or this all-time high, and you are getting there. So that value, I think, was 258. And again, remember, when we do breakouts, we can go to technical analysis, and we like to see a 2 times X of our average true range. So we can see that is close to about $5. And if I look at my chart again, and I break this out a little bit, let's look at this in a little bit higher time, well, a little bit more space here. If we add $5 to 258, 257.50, that gets us around the 264-ish, 263-ish level, which would be more of a confirmation of a breakout. If we got above there, then I think, to me, I would probably be adding to my already, full disclosure, long position in this ETF. And if we look at a more common Fibonacci extension, the 127, that would put the GLD up around 294-ish. Now, if I translated that into gold prices, remember we're trading at a $200 discount or a $20 discount, because this is 1/10 of an ounce of gold. That would put gold probably closer to $3,200. And if the dollar continues to weaken, then I think this could happen very, very quickly. Now, again, I think it's all related to the dollar. Now, I thought was kind of interesting today was, let's go into options, and under unusual options activity, somebody tends to agree with me, and we had somebody who bought 23,263 calls. Now those are February's, and I want to put this in the perspective here. This is about a $6 million bet that the GLD is going to go to 263 between now and end of February.
Seems like an interesting trade for sure, John.
Something for us to watch, at least, right?
Absolutely. And John, let's pat ourselves on the back a little bit, because we've talked about gold in the past when it was kind of showing some weakness, and we've said, hey, this could be a period of consolidation. So if you miss the initial run up in gold, this might be another chance for you to sort of load up on a position if you were interested in doing so. And if for those who did, it's worked out pretty well.
Yeah, it certainly has. And right, we've been kind of in this sideways motion from about mid-November of last year to just currently this week.
So for those of you who are watching for the first time, stick with us. We've got some gems occasionally, right, John?
Well, blind squirrel finds a nut occasionally, that's for sure, right?
Absolutely. All right, so let's go back to equities, John. If there's one stock this week besides NVIDIA, which is showing weakness, there's another big tech stock which has done just the opposite and just keeps showing incredible strength, and that is Meta. Now, Meta had earnings on Wednesday after the close. Very well received by the market, John. In fact, Meta as you can see right now, John, barely hanging on to green, but the market is red. So again, another strong day for Meta. It's going for its 10th straight green day, John, which was the longest winning streak since September 2015. And John, we've got a market right now where bulls and bears are kind of squaring off against each other, right? You've got bears pointing to certain data points and saying, see, aha, it's weak. You've got bulls doing the opposite. But if you're looking at big tech earnings and you're a bull, you're saying, hey, look at this, guys. Nothing to worry about. We are riding high and ready to go. What do you think, John?
Yeah, I mean, I don't discount what you're saying. From what I've been noticing in the Mag 7 is there's been this micro rotation inside the Mag 7. It seems like one or two of them tend to hold the whole market up while the other ones have corrections. A great example is look at what Apple has done over the last couple months, right? It had a big drop down, and then all of a sudden, boom! It just ripped up as well, going into its earnings as well. But from a trading aspect here, I think what I would look at it in this case is, I'm going to look at this in terms of volatility, in terms of price movement. And so one of the things I like to look at is Bollinger Bands. And Bollinger Bands really kind of tell us it is trend identifying, it's volatility identifying, but there's also one aspect of this called mean reversion. So I do like when bands are narrow and we are breaking out of the bands. That's usually a good sign that you're seeing a very powerful trend. What gives me caution, though, is when the bands get super wide and bandwidth gets wide. That is telling me that maybe the market has gone too far too fast in a short period of time, and that there's something called a mean reversion of a higher probability. Now, typically, I'm not concerned about it being outside of the bands. It's when it goes outside the bands and then comes back in that I feel that there's a greater propensity for it to go back to what is called the mean. Now, let's look here. This is the daily. Let's look here on the weekly. I always like to start at a little bit higher time. And you can see, if we go back in time here, this is the farthest we've been outside of the Bollinger Bands. And gosh, I don't know, maybe 5 years, maybe even historically on Meta. So that really tells me that this stock has gone too far, too fast, in too short of a period of time. Doesn't mean that it can't continue to go higher. It just means that it probably needs to digest or breathe or maybe even pull back. So in terms of looking for trading opportunities, what I might do is in uptrending markets, and you can kind of see it here. And, here's where we're kind of going along the bands. Typically, I like to find a market that is trending that stays in the upper half of the band. It doesn't necessarily have to go back to the mean. Typically it does. But if I looked at this, I like these big green candles. These are kind of telling me this explosion. It means this is where buyers really start to step in. Ideally, I like to buy at the bottom of a green candle, which would put us at the reversion mean. But strong bull markets don't pull back there. So what I usually do is I'll come in here and I'll get out my little 50% tool, and I'll just divide this candle in half. And whoops, did I get it? Let's do it again. Whoop, there we go. Divide this candle in half, apply. And what I'll do is if it comes into this green candle, I'll kind of use this as maybe a potential limit order, or wait and see if it falls down to here. And then as it comes back above this green candle, take a confirmational entry on the way out. So to me, Thomas, I think, the story is very strong for Meta, but to me, I think it's gone too far too fast. And I would rather look for in this case, a better buy the dip opportunity than one that was where we have a fundamental change, either real or perceived.
Yeah, I'm very bullish on Meta. I have a position in Meta, John, but I really like your analysis there. Especially, and we probably have viewers in the audience, John. Like with all things, when it gets too hot and they're left not with a position, they're sort of asking themselves, okay, should I chase this or should I wait for a pullback that may never come? And I think when you laid out with the way you did, I think that really helps a lot of viewers out there. So, all right, so let's move from a mega cap hot tech stock, John, to a smaller, slightly smaller market cap, but potentially an even hotter stock, John. We've gotten questions every week, it seems like, about this. So we're finally going to dedicate a full segment to the stock, John. And of course, I'm talking about the one and only Palantir, John. Now, Palantir is a stock that seems to have two different camps, John. You've got the bulls who just love it and they say this is going to be a multi-year runner. And you've got those who are just swearing it off saying, no, I don't think so, folks. John, which camp are you in?
Listen, again, I just let price tell me what it's doing. And again, let's look at this from a performance basis, similar to what we just looked at in Meta here is, here's a stock that if we look at what it's done over the last 52 weeks, it's up almost 400%. And if we look at what it's done over the last 6 months, it's up 200%. So, I mean, the momentum is certainly very, very strong. So the bulls are definitely winning this case. But again, to me, as a trader and as an investor, what I get a little bit weary when a stock has gone up 400% in a very short period of time in terms of an investing window. But in even a shorter period of time, let's say, it's up in the last 3 months, it's up 100%. So that is what we're going to go into the analysis looking at. But I think you pointed out to me, this is kind of the reason why you've been attracted to this stock, right?
Yeah. So, John, we got a question. I think it was about 4 shows ago. Somebody was asking about, is Palantir, is the strength going to continue? And I said, look, I have been on the sidelines just watching the stock go up and up and up. And John, I got sick and tired of it. And I just said, you know what, I'm going to buy this damn thing because my emotions are just getting shattered having to watch it go up and I'm sitting on the sidelines. But, John, I actually took this, funny enough, I took the same approach with NVIDIA, John, when it was trading about 75. That worked out pretty well for me. And
yeah.
I'm hoping this strategy with Palantir is going to work out as well, even though you thought it was kind of a crazy man style.
Well, I mean, it's the old chase scenario, right? That FOMO chase scenario. All right, so let's look at this one. So let's look at this from a little bit of a different perspective. First of all, coming into earnings, which is going to be, I think earnings is next week. When is it? The 3rd. So that's how we're gonna dissect this one. We're gonna look at this first from a technical analysis, then we'll look at earnings and how maybe we can trade this. And we're gonna take Thomas's perspective that we're super bullish on this stock. So, or at least give Thomas some ideas what he can do. So again, I think what we have to worry about is this market is already priced for perfection. But let's look at this from, let's say, a little bit of a different aspect. And I'm going to look at something that I don't really normally share a lot, but I'll look at something, for instance, is called the money flow. Now, typically with the money flow here, it says that it's kind of like an RSI. Is when it gets to the upper end of the range, it's really telling you that the market is overbought, and that is a cautionary tale. But you can see that where we got overbought and the stock still continue, and it's not necessarily a predictor of price change. But the Chaikin money flow is trending lower, and that is something that you do need to be aware of, which is kind of telling us that this stock is kind of stuck in the mud. Now, that doesn't mean anything. It still means it could go higher, and certainly we might be waiting for a catalyst for this market to go higher. If I look at this through the lens of, let's say, accumulation and distribution, right? It has been kind of sideways for a while, but yeah, just recently has picked up. So let's look at this in terms of what Thomas wants to do. And he's saying that he's going into earnings and he feels very bullish on it. So there's a couple ways that we could do this. I think the first and easiest way is, we could just buy calls, right? But if we go into, let's say, options pricing here, and, we look at, the implied volatility. Now let's look at the weeklies that are going to expire on Friday. So we will encapsulate the earnings here. The rank is up around 90%. And if I look at the percentile, that's super high. And if I get a look at the implied volatility on this one, it's very high. So to me, that buying just a call is too expensive. If I go to, let's say, okay, let's buy the stock today going into earnings, and let's sell a cover call against it. Now, again, let's go and look at that through this lens here. So what's the current price here? $82. So let's say, well, let's do this first. Before we do that analysis, let's go into our expected move. And for our expected move, if we look at, here's our earnings, and then we can see the expected move right now looks like $92 onto the upside based on the earnings. So what we could do is we could buy our stock today at around $82 and then sell the $92 call strike. And that would be here. And if we're right, if Thomas is right, you're going to make 14% in, what is that, a week's time? And if you annualize that, it'd be 770%. Well, that you could do that, right, Thomas? That wouldn't be a bad deal, right? But let's look at from, maybe you don't want to buy the stock, right? Right. So we could do a vertical call spread. And again, I think in this scenario, bull call spread, because our rank and percentage are super high, we might not get the benefit of a call spread. But let's do this. Let's use, what was it, $82. Let's buy at the money. And we look at 82.92. Again, here's this little payout. I like to do vertical spreads, but I like to get payouts where I get 2 to 1 or greater. I don't want to spend too much money. I only want to spend about a third of the range of that spread. So this is a little bit less than that. Now, what I could do, or what Thomas could do here in this case, is if he's super bullish on this one, he could do this call spread in hopes that you do get a price appreciation, that maybe we don't get above the expected move, and then you could exercise your $82 calls and capture that premium of the $92 call, and then have that stock go higher. And the way you could enhance that trade, again, this would be more of a Texas hedge, we call this, is, again, if you're really bullish on this, I would look at buying that call spread and then picking out a value where I'm willing to buy Palantir. So we looked at that expected move. Again, let's look at that expected move to the downside. The expected move on this one is $72. So we could do a naked put. Now I'm going to have to put capital out on this one if the stock moves lower. And again, let's look at that February strike, and at $72, you could pick up another $1.60, $1.70, and that would offset the cost of your vertical call spread. But again, and this one, you do get protection of a 14% downside of not getting exercised on the put. And then again, if we look at our expected move, Thomas, on this one, the expected move, I believe, is right around, well, it's a little bit less today. This morning when I looked at it, it was right around 14%. So all those numbers kind of all work together. And I think your point is why you like this trade is that if you look at the last few earnings, right, you can see that we had a 30%, 10%, 23%. So 3 of the 4 last earnings had a positive result and only 1 bad result. And that bad result was only 15%. Yeah, 15%, still 15%. But it would be on that range of that expected move of that $72 strike, which we said was around 14%. So there's some ideas for you, Thomas. For you.
Yeah, and John, one of the questions we got is, what are the best option trades for a small portfolio less than $10,000? This is a great example, John, and here's why. Not everybody is going to want to go out and buy 100 shares of Palantir just so they can sell a covered call, right? Because that's going to require about an $8,200 allocation, right?
Right.
And that's not going to be for everybody, John. It's a very risky stock. You're buying it heading into earnings, and as you can see, yeah, 3 of the last 4 have been huge winners. But John, this could just as easily be a minus 20% in any of the quarters coming up. Who knows if it's going to be the one next week? So the vertical call spread that you kind of walk through, John, that could be a way for smaller players to participate in the upside of a volatile stock like Palantir.
Again, if I'm on the cheap, I really want to see that 2-to-1 payout ratio, because now I know I'm only spending about a third of the spread to capture 2/3 of that spread, right? If I'm starting to get into like that 150 or 1.5 or 1.7, now I'm spending, closer to, would it be closer to maybe a half, right? I don't know if I want to do that, right? Maybe that risk reward. Again, that's up to the individual trader and what is their risk appetite. Okay.
Yep. All right, John. Great wrap up there with Palantir. John, we've covered a lot, but are you ready to cover some more? We've got some questions coming in.
Yeah, sure. Let's hit some questions.
All right. So the first thing, John, we want to do is we had a question last week, which was, why doesn't Barchart have futures screeners? And we kind of answered it a little bit, John, last time we touched on it. Do you want to give kind of a more in-depth answer this time around?
Yeah, I originally had to think about it, and at the moment I didn't really have time to really go into deep, and then I did a little research and I asked our developers some of the reasons why. But it makes a lot of sense when we had this discussion, is that when you think about screeners, stock screeners or option screeners, we're screening a lot of candidates, thousands of stocks and thousands of different options. And options are standardized contracts. But when we get into futures, right, there's so many different variables that we have to be aware of. First of all, there's, multiple months. So which months do you screen on? For instance, in the crude oil market, we trade out to 10 years. Well, that means there's 120 different tradable month contracts. Now, not all of them are actively trading. Some of them have enough open interest that would support trading, but they might only trade maybe once a month or once a week. So, a screener might not pick those up. The other thing is we have to talk about is, expiration dates, right? When is the expiration date? So you could say, well, let's trade the nearby or the front month, right? Well, there's this rollover as we get to expiration, and every contract or every futures contract has a different expiration and how the market reacts to that expiration. So that could distort. You could be looking at the spot month, but the market has already rolled, into the next month. Take agriculture, for instance, in the corn market. When we get to the May spot month, well, the market is actually starting to look at the December contract, and they might be doing opposite price actions. So, and the final thing is that there's really only about maybe 15 or 20 really active futures markets for us to trade. So we don't do those screeners for a lot of those reasons, but we do have some of these pages that act like quasi or de facto screeners that you can use. Now, the other thing that you can do is, for instance, is I could go in and look at a custom view, and a lot of the features for you guys will recognize a lot of the features that are in custom views. In other words, some of the filters are the same ones that you'll find in the screener. They just won't give those parameters, those absolutes. In other words, a field or a higher or lower. But you could look at, new highs or moving averages. So you can build a custom view that can be kind of like a screener. So, for instance, let me give you an example of that. So as Thomas tees up the next question, go ahead, Thomas. So let me go and find futures. I do have a futures watch list. I know I do. There it is. So I can come down here and, for instance, here's my futures trading guide, which is kind of a screener for us. And here I'm doing some custom views based on those inputs. Now, again, they're not screening saying, "Oh, I want an RTA, an ATR that's above a certain value," but at least I have that information in front of me. Okay.
All right. Good job, John. Next question is tariffs, John. Tariffs have been a big topic of conversation in the news lately. Do you think they're coming? Do you think or do you think it's more bluster? If they do come, John, what impact do you think they'll have on the markets?
Well, I mean, I personally, I think tariffs are really more of from I'm seeing with Trump, is more of a negotiating tool. But if you bluff a lot of times, then eventually somebody's going to call your bluff, and so I think they're going to have to do tariffs. I still think that they are inflationary in nature. In other words, they make goods more expensive. They are de-globalizing, which again I think tends to add to inflation. Now, what do I think about the whole market or individual sectors? I mean, that depends. But what I can tell you from because of the industry that I've come from, if we get a tariff on Canada, a 25% tariff, and that would be Canadian oil, that is going to raise the price of oil here in the United States. Now, why do I say that? Well, that's because our refiners in the United States have been formulated or designed to take in the Canadian crude, these tar sand crudes. Now, they're more heavier, or what is called sour crudes. So if we raise the tariff on that crude oil and we don't allow that, that's going to raise the price of the input cost to refiners in the United States. That is going to create that inflationary aspect. Now, the problem maybe, or might be an opportunity, is if Trump is bluffing and he doesn't raise tariffs, let's say, on Canadian products or exempts the oil industry. You can see, for instance, here's Canadian Natural Resources, which is one of the largest Canadian producers of tar sands, and you can see the market is already kind of, of recent, is kind of discounting, or is actually taking into consideration of these potential tariffs if Trump were to enact them. So I think this company, if tariffs do occur, this might actually be a buying opportunity. If no tariffs come, I think then this could be one of those stocks that might benefit. But certainly our refiners, now I'm again drawing a little bit a blank here. Our refiners here have had some difficulties. Valero, yes, thank you, in my head. So they will continue to have some difficulties. Let's look at this over a 1 year period, right? So I would watch those two in that essence. But overall times, I think tariffs are going to be inflationary no matter what industry you look at.
All right, John. So we've had a ton of questions come in. So maybe let's try to rip through them as best we can.
Yeah, I'm sorry about that.
Yeah, no worries, no worries. John, we covered NVIDIA pretty in depth, but what about DeepSeek? Do you think DeepSeek is a serious challenge to NVIDIA, or are you kind of on wait and see mode with the?
I'm definitely in a wait and see mode because, anything that comes out of China, I discount. I don't know how true it is. I'm reading a lot of different stories that, there's people that are in the industry and it's like, no way they could have built this computer for that amount of money, or that there's a lot of talk that really what they did is they just copied Chat GTP. So, there could be some infringement rights there. So there's a lot of uncertainty about it. But, now that Baba has come out and said that they've done the same thing, a lot of folks, when you think about the NVIDIA, they're saying, this kind of what is called the Jarvin effect, right? That is, technology becomes cheaper, it actually increases the demand for that technology, and they're saying that NVIDIA stock is going to go up because there's going to be even more demand for AI. I think the market's got that wrong. I think NVIDIA is the premier chip, but what if these companies are creating these AI programs using cheaper chips. I think what that does is it levels the playing field for all chip makers. And so maybe the buying opportunity is not NVIDIA, but HMS, that's it. There we go. Would be to buy the semiconductor space. But again, look at what we just recently saw, right? Here's an end of the road gap where we fell. Not only did we throw the 50, but we fell below the 200. Now, we tried to recapture the 50 this week. We did close below, and it looks like we closed below the 200 days. So maybe what the market is telling us that both of these are disruptive, and this is going to challenge the Chat GPT or the Microsofts, right? But we talked about this before. Is I think all these big companies are all in on this. They're poker committed, so pot committed. So I don't think the money is going to stop flowing. I think if anything, more money is going to flow into it. It just depends on where it goes.
All right. So, John, so this is a question using the example of Vertiv, VRT. I don't think it's a Vertiv specific question, but more how would you handle a situation like this? So if you look at Vertiv, John, the stock fell off substantially. It's trying to mount a comeback, sort of what I call a grinded out comeback where it tries to get back to the level that it was. John, you see a chart like this. Do you consider this a good entry, or are you sort of going to wait until it gets closer to those all-time highs?
Again, look, this is just playing in exactly the same way we just learned about it. It fell below the 50. It went to the 200 now, but this is a nice V bottom. So I like this a lot better. Now, what I really like to see is just to recapture that high of that gap and then fill into this gap. But again, this 50-day and 20-day is going to act as a level of resistance. And really on this one, when we get back to the origin of this gap, that's going to act as a level of resistance. So is this an investment trade, or are you going to play the momentum, short-term momentum? I do like this V bottom, but this plays into this scenario. Is there some kind of fundamental change that is happening in the greater market? Now, remind me what this company does. I think this company does have something to do with, it's in that space, right? So, something that we need to be aware of. Now, I'm going to give you an example here. Let's go real quickly, and go ahead, Thomas, tee me up another question. But let me look at my end of the road. So again, one of the stocks that I have in my portfolio is EQT. Now, I think it was in my list here. No, it wasn't. But Quanta Services is a similar stock that is in that space. They buy and sell, they build data centers. Go ahead, Thomas. Ask me the next question. I'm just looking this up because I kind of want to look at this. That would be power. There it is.
Yeah, next one, John, is it's about Apple. So Apple had their earnings yesterday, basically unchanged, John, and didn't really do much. Any thoughts on Apple here, John, or you're just kind of checking out on it for the time?
Yeah, again, I think this is one of those that inside the Mag 7, we're getting this kind of this micro rotation that each one of them, one of them comes into favor and one of them goes out of favor. Where's my Mag 7? Here we go. I'm in that camp that, Apple has just really become a phone company, and it really hasn't innovated anything of recent. But, we are into that new Apple cycle, so maybe that could drive the stock higher. Again, this is a company that is pot committed to AI. So, they're going to chase that. So, again, we had a big up day and then we ended up finishing loaded. I don't like that. That's a kind of a key reversal to me. So I think this is a wait and see right now. And buy, sell, hold, I would say would be a hold.
John, any thoughts on UPS? And this is funny because we had talked about UPS. And what
it is.
UPS yesterday, John, they had their largest drop in history, John, in history. That's not great. What do you think it means, John?
Well, I think UPS is like kind of one of those stocks, and I know you and I had this little debate about this. that you can look at certain stocks, like, you hear the expression Dr. Copper, that copper is kind of gives us this sense of, economic activity around the world. And when copper prices go up, it tells you the economies are strong. When copper prices go down, it does weak. I think a stock like UPS does do this. Now, there might be something fundamentally wrong with this company, and maybe it's just, maybe it's mismanaged or maybe something else. But again, a lot of these correlations don't happen instantly. They take some time. And this is not, to me, this is kind of the canary in the coal mine where, if UPS is not doing well, this is old school market analysis. If you go back to Charles Dow, where if the transportation stocks are not doing well, it means that goods and services are not moving, or goods are not moving. So to me, this is kind of a canary in the coal mine. Now, what could this be? Could this be a capitulation after a long defined downtrend? Now, I drew this line, and I drew this line a while ago, not because of what you and I discussed. That is, notice if we go back in time here, this is kind of where, we're going back to 2020, but let's go back here and notice where this blue line was. And it looks like it got off a little bit here, but what do we see there, Thomas? A little gap, right?
Little gap up, yeah.
Yeah, a little gap where the market did what? Broke out above its 200-day moving average. And so the market has fallen, and this is a bad thing for UPS, but it has fallen to that origin of, let's say, a multi-year uptrend that turned into a multi-year downtrend. So this could be a capitulation for this stock.
John, any thoughts on nat gas? So we've covered nat gas, and it's taken a bath since, John, just falling apart. What do you think's going on there?
Yeah, I said you got to watch natural gas. You got to watch the 15-day forward forecast. We came out of the last couple of weeks. We were in the freezer. Now we're seeing that the temperatures are going to be above normal. So in the short run, I think the natural gas market is under a little bit of pressure, but I think it's at a level where you could start thinking about maybe buying a dip again. And I'm very bullish on natural gas on the long run. I still think that the adoption of green technologies is being delayed, and so that's going to put more pressure on natural gas as a substitute, or that transition to green energies. We just came into contract rollover too, which sometimes has a funky effect on the market. So, again, we're watching what is going on in the energy space. Again, here I would say, I would be waiting for, a little bit of a positive information on this one. But again, one of the also things I said is you need to watch what is going on in Europe in terms of their energy markets. And going forward, they're going to get the cold weather that we got. And if you look at, for instance, the natural gas market over there of recent, let's look at their chart, is theirs is breaking out. So that is going to be supportive to ours, because our gas gets turned to LNG and then it gets sent to them. So I think there's a buying opportunity in natural gas. I don't know if you want to buy the futures. Again, full disclosure, Thomas, I don't want to spend a lot of time. EQT, one of the largest U.S. Natural gas producers, even in the face of falling natural gas prices. Here's a stock, we just talked about that end of the road gap where it did not fall to the 50-day and now is recapturing, going into that gap, and it's actually outperforming based on what is going on in the actual physical natural gas market. And I think this is a stock that I think when we look back 3-5 years from now, we're going to say, wow, we had an opportunity to buy this at $50, especially when natural gas prices will probably be closer to $4 or $5.
John, any advantage to using Bollinger Bands over Keltner channels?
It's just how you feel like Bollinger Bands are standard deviations. 2 standard deviations is default, where Keltner bands are average to range. They're a little bit more adaptable depending on how you use them. I know some traders like myself will use a 1.5 times. I know others use 2 times. Sometimes I use 3 times ATR. ATR is a Benjamin of volatility. It just depends on how you want to look at a market. So I don't think there's an advantage over one of the over the other. I will point out to you is we have a screener which is called the TTM squeeze, which actually looks to see when the Bollinger Bands, the 2 standard deviations goes inside a 1.5 ATR, and that is usually a sign that your stock is building up this energy, is ready to break out. So this is a great screener tool for you if you like that technical analysis.
Let's see.
One more, Thomas, because I know you have a special announcement for us.
Yeah, let me going through a couple more here. John, any thoughts on Microsoft? The comment is that their earnings were not bad. So I guess the person is wondering why did Microsoft fall when the earnings were not bad?
Yeah, why? I don't know. But again, all I can do is look at the tape, right? And again, let's go back to what we've kind of been discussing this whole day is here's a stock that's been, since we had that end of the road gap where we have yet to recover that gap. We've kind of been making higher lows, but we're kind of been trading sideways. Now, let me change this template here in terms of my moving averages. We fell below the 50 and the 200 day. So to me, this is definitely a stock. If I had this in my portfolio, now obviously if we own the indexes, we all have this in our portfolio, but I would definitely be looking in for some opportunities to look to do some kind of hedging on this one, because this one could be turned into like one of those stories where it might need to go a lot lower before it goes back up, or before it goes back up, before we could get bullish on this one. It's got a lot of work to do, a lot of wood to chop.
All right. So we got to most questions. Guys, if we didn't get to your question, come back next week, ask it again. Put a little note that we didn't get to it last week, and I'll put them at the top of the pile.
Yeah.
John, next week, you and I are both very excited because we have a special guest, Barchart contributor, Darren Newsom. John, Darren is a great author. He's been trading for years. He's got a lot of knowledge. And you two are going to have a spirited debate, John. Now, I came up with a little catchphrase, John, when I'm going to tease it for next week, which is technical analysis hocus pocus or the pathway to profitability? So you and Darren are going to debate that, John. And if you guys are interested in the answer to that question, make sure to tune in next week.
Awesome, Thomas. Great job. Folks, I appreciate you spending time with. I know we went a little over today, but I hope you guys got something out of today's session. If you're watching on YouTube, give us a thumbs up and drop us a comment. Tell us what you like. You can put in some questions in there as well. We'll try to get to them. Until next time, best of health, manage your risk, and the good of all trading.